I welcome you all aspiring and inspiring and patient entrepreneurs and all the happy investors to this fourth part. Yes, Stock 4 Prime, as we all can just understand this thing that in the previous video we have learned about market cap, enterprise value, PE ratio, PB ratio, dividends, face value, share premium, and promoter holdings. And in this video we are going to cover some major and most important terms, and you are really going to watch this video again and again and again, and I really want you to just focus completely. Just forget about everything which happened in this day and whatever things are going on in your mind right now. Just forget everything. See, when you think about money, when you think about people, when you think about the past, these three things are the thing which will completely make you sad, which will completely push you towards overthinking. So I just want you to tell this, and I just want to make you aware right now, right at this moment. I want you to focus completely on what is going to give you money in future, on what is going to give you happiness in future, and what is going to complete your family's dream. So your family and that smile on your dad's and mom's face, for that you need to forget every single thing which people told you or just screamed at you or just whatever situations you went through. Just forget about it and completely focus to this. I very good evening to you all, or I think by uploading it will be good morning. So very good morning to you all. My name is Shubham Bish and I welcome you all once again back to this amazing platform of YouTube named as Happiness Prime. This Stock 4 Prime video where we are going to learn with example about the three major terms: debt equity, profit after tax margin, that is PAT margin, that is also known as net margin, and third we are going to learn about return on equity, ROE. So let us begin this video with the first term, that is debt slash equity. What is equity? Let's understand this with an example. If I'm starting a company and I need fund for my company, so if I invested my own money, or I invested my friends or families or companions or somebody I know, I borrowed money from them in favor of the shares or the stock of the company. So I gave them some shares, I took some money. So this is known as equity. Secondly, what is debt? If I took money from my friends, if I took money from the bank and I need to repay the money in a fixed period of time with the interest on that amount, the principal amount, then that is known as debt. What is the main difference? That in equity you don't need to repay the amount with the interest in a fixed duration of time, but in debt you need to repay that amount in a fixed period of time and with the interest amount. So that is the main difference between debt and equity. I hope you understood this very clearly. If you have any doubts, you can just resume, just pause this and just rewind this last 1 minute. Now we are going to shift towards PAT margin. This is one of the major terms which you have to listen very carefully. I'm going to speak it very loud and clear and slowly and with a very easy example so you can understand it very clearly. Let's start with the profit after tax margin. The full form of PAT margin is profit after tax margin, and it is also known as net margin. Now let's take an example of a chair. Let's take an example of a chair. Let's say if I bought a chair at 100 rupees and I sold the chair at 150 rupees, then what is my profit margin here? Profit margin is calculated as selling price minus cost price minus the expenses which I did while selling that chair. The amount which comes, that needs to be divided by the selling price into 100. That is known as profit margin. I'm going to repeat it once again. Just listen this very carefully. Selling price minus cost price minus the expenses which I did while selling that share. The amount which comes divided by selling price into 100. So in this case, in this example, 150 minus 100 divided by 150 into 100, that comes as 50 percentage profit margin. So profit margin is always calculated on the selling price. Yes, you got it right. And if you got this example, then you are definitely completely focusing on this thing. So I am really blessed, and I am just tapping you. So you have to focus on the other ratio, which is ROE, return on equity percentage. Just keep up the same focus, keep up the same amount of focus, and I'm going to just clear this out to you. Return on equity. What is return on equity? Let's take an example of a company. Let's take an example of Dixon Technologies. Let's say example that one share of Dixon is of 1000 rupees, and I invested, let's take a time period of 1 year. If I invested 1000 rupees in Dixon and I bought one share of Dixon, and after 1 year the share became of 2000 rupees. So what is the return on equity? What ROE I got on Dixon? 2000 rupees minus 1000 rupees divided by 1000 rupees into 100. Now let me tell you the exact formula for return on equity calculations. ROE percentage is equal to selling price minus cost price divided by cost price into 100. So ROE, return on equity percentage, is always calculated on the cost price, but PAT margin is always calculated on the selling price. Yes. So this was the biggest difference between PAT margin and ROE percentage. Now we have very nice example where you will get to learn the biggest differences. Like, just let me give you an example why DMart and Walmart makes such a huge profit, just such a huge ROE percentage on the similar PAT margin. You are going to discover that the PAT margin will remain the same, but ROE percentage will increase. Return on equity percentage will definitely increase. Oh my god, so much hustle behind making these videos just for you, so you can learn. So I'm going to just give you this example. I just need your focus. Listen this very carefully, so you don't have to remind, and just note down completely and you will understand this. It is very easy. Just stay focused. Example is just, let's take an example of pencils. Let's say there are two people, Sam and Ram. Let's take Sam and Ram. Sam bought 10 pencils of 10 rupees, and Sam also bought 10 pencils of 10 rupees. Sam and Ram both bought 10 pencils of 10 rupees. Let's say an example that Sam sold all those pencils for 20 rupees. At the end of the day, how much amount did Sam has? 20 rupees for each pencil. That is 20 into 100. 200 rupees he have right now. How much did he had in the starting? Minus 100 rupees. 200 rupees minus 100 rupees divided by 100 rupees. How much is it? That is equal to 100% is the ROE percentage of Sam. Now let's take an example of Ram. Ram bought the pencil for the same amount. One pencil equals to 110 rupees. So Ram also invested 100 rupees. He got 10 pencils and he sold all the pencils in a little less price. That is 15 rupees. Let's say Ram sold all the pencils for 15 rupees. So 15 into 10, that is equal to 150 rupees. Now 150 rupees minus 100 rupees, 50 divided by 100, that is 50 divided by 100, that is 50% ROE, right? Sam got 100% ROE and Ram got 50% ROE. Let's calculate the profit PAT margin. How to calculate the PAT margin? In case of Sam, 100, what was the profit? 100 rupees divided by what was the selling price? 200 rupees. So what is the PAT margin? 100 divided by 200, that is 50% PAT margin. And in the case of Ram, just one second. In the case of Ram sold it at 50 rupees profit divided by 150 rupees into 100. How much is that? Is equals to 33% PAT margin. Now, how much pencils did Sam sold? 10 pencils. How much pencils did Ram sold? 10 pencils. Now, let's take an example that Ram, due to the reason that he was selling it at a lower price, Ram got more time. So, if Ram sold at the end of the day, in total, if the Ram sold 30 pencils, so here, how much did he invested? 30 into 10, that is 300 rupees. How much did he got in return? 30 into 15, that is 450 rupees. 450 minus 300 divided by 300, that is 150 percentage return on equity, ROE. And how much is the PAT? That is 450 rupees he sold and 300 rupees he invested. What is the profit amount? That is 150. 150 divided by selling price, that is 450 into 100. Similar, that is PAT margin remained the same, 33%, but return on equity, ROE percentage increased to 150 percentage. And here the return on equity percentage of Sam was how much? 100 percentage. So this is the main difference, that company sells the product at a lower profit margin, that is PAT margin or net margin, that at a lower price company sells higher amount. The repetition of selling of the products is higher. That is the only reason that company is having lesser profit margin but higher ROE. And in the same case here, the selling price was high, so the user was not able to sell much quantity, and that is why the return on equity was 100%. But the profit margin, you saw the difference, how instantly we can just understand, and how easily we got the fact that how DMart and Walmart are selling products at 1%, 2% or 3% PAT margin, and they are repeating the selling of that own product. So the ROE percentage in total, the ROE percentage is higher enough. So this is how big difference makes about ROE percentage and PAT margin. So I hope that you got to learn the best from this example which I just denoted verbally. Let's just imagine how much mentally present I am right now at this situation. So I just gave my best to just teach you this PAT margin and ROE margin. That is one of the best things you can learn today. If you didn't got it the first time, which it might be possible that it is very hard to get, but still, if it is the reason that you didn't got this in the first time, then you have to remind this and listen it once again very carefully. Like, it is very easy to understand. Let me just repeat it once again. What is PAT margin? PAT margin is selling price minus cost price divided by selling price into 100. And simply we can say that profit divided by selling price into 100 gives us the PAT margin. What is ROE percentage? Selling price minus cost price divided by cost price into 100. PAT margin is always calculated on selling price. ROE percentage is always calculated on cost price. So that was the complete explanation of ROE, PAT margin and debt and equity. Let's see some live examples in technology and then we will end this video.
Let us go through some live examples of debt, equity, profit margin and ROE, that is return on equity. Here you can see V-Mart Retail Limited, that is retailing sector, and here you can see the profit growth of the company is 2.97%. If we see the ratios, here you can see the profit growth graph, that is minus 19% in 1 year. That is not good, but still let's see the profit growth, that is 2.97 on an average. It is profits growth right now, that is it shows the net profit over a fixed period of time. And here if you see the ROE percentage, that is 11.49% right now. Let's see some other companies of the same sector, the retailing sector. Here you can see Avenue Supermarts Limited. Avenue Supermart is one of the nice stocks here, that is 2088 849 rupees stock. And here here the profit growth is 4.99 percentage, ROE is 16.20 percentage. That is a real good one. Another, let's take another example, that is of Morpin Laboratories Limited. Right now the stock jumped more than 100%. That is, right now it is 59.30. If you see the rates of the charts, let's check this out. It was trading as at 24-25 rupees, and now it is right now 61 rupees, or it went to 68 rupees also on my third. That is very nice. It's like more than 30%, 300% growth here. Then let's check out its profit growth. It is 4.08 percentage profit growth, and the ROE is 11.06. That is very nice one. Then let's check out one more company, that is Page Industries Limited. You can see the stock price, that is 28,869 is the current Page Industries stock price. And if we check out the profit growth here, you can see 11.65 percentage of profit growth, and whereas the ROE is 43.04 percentage. That is, return on equity is very nice. The company is giving so good ROE percentages. See, it is constant. It is not even decreasing rapidly. It is just constant. 46 in 5 years. 3 years is 45.82 percentage returns, and in 1 year company is giving 43 percentage returns. So overall it is a very nice one. So this was the live examples of the ROE percentage and the PAT margin.
I hope you got to learn the best from the PAT margin, the ROE percentage, the debt and the equity, and you got to learn about the importance of these margins while doing value investing, while doing the stock analysis. So thank you so much for being in this series, and I really hope this one thing, that I am just sharing each and every value I learned, I experienced, I practically implied, I got the results, and now I'm here just sharing each and every bit of information with all the hustle and all the mental awareness I have. I hope you got to learn everything. If you have any single doubt, if you have just one single doubt, then also you can contact me on the number which is given in the description, or you can leave your query or your question in the comment section. It would mean a lot to me, and just to me. So I hope you get to learn the best. I hope your all the doubts gets cleared, and I hope you get to learn the value investing very soon. Just a few more videos, not much, just a few more videos, and we will be ready, and we will be the best investors. So just keep calm, have patience, love your loved ones, create a very nice environment around you, keep all the people happy around you, and remember this one thing: God makes it happen. If God has put you in a conditions, then definitely God has this one thing in mind, in their mind, that you can definitely get strong from it and get strongly out from it. So believe in God, have faith in God, keep hustling, keep hardworking, and always think about to make your family proud. Thank you so much. Share this video with one friend, just one friend who needs to learn more about stock market.